What we're going to be looking at here is governmental accounting for the proprietary funds, just a basic overview of what these proprietary funds are and how they operate. And those would include here the enterprise fund and your internal service fund. So when you're talking about governmental accounting, you're going to have these different governmental funds here, like the general fund, specific purpose fund, capital projects, and so forth here. And then we get down to the proprietary fund. So that's what we're going to be looking at here in our discussion here. Now, along with your governmental funds, you're going to have your accounting control groups, like where you're going to account for your general capital assets and any general long-term obligations or debt. And when you're talking about your typical governmental funds here, like the general fund, specific purpose, capital projects, this is where you're going to account for these capital assets here and long-term obligations outside the funds themselves. But the point we want to make here with the proprietary fund and also the fiduciary fund, you account for your capital assets here and any long-term obligations within the funds themselves. So, and when you're talking about the proprietary fund, you're talking about fund capital assets versus general capital assets that you'd be using here or accounting for here in your typical governmental funds. Okay, so let's look at this proprietary fund here. Proprietary funds, this is where the governments account for their business type activities. These funds are to be self-supporting, like a commercial business. The accounting procedures resemble that of a commercial business. The funds carry their own fixed assets and long-term debt. And any governmental budgetary and encumbrance accounts are not used. Well, there would be a budget for your proprietary funds, but there's governmental budgeting here where you have your appropriations and estimated other financing uses and sources. We wouldn't set up that governmental budgetary account. And then again, encumbrance accounts, those are for like your purchase orders and your contracts you issue. They would be counted for. These funds would use normal accrual accounting, so you wouldn't be setting up the encumbrance system here for any of your purchase orders and contracts. Just use normal accrual accounting. So okay, so we have these two funds here. We have the enterprise fund here and your internal service fund. So the enterprise fund, well, that's going to account for the goods or services provided to the general public, like electric utilities, water utilities, and so forth, maybe a public parking, municipal landfills, airports, and so forth. So those are any goods or services provided to the general public are going to be set up in an enterprise fund. So you'd have an enterprise fund for each one of your, in this case, the utilities, and each one of them get a public park, and each one would get their own separate enterprise fund. Now, the other fund we have here is the internal service fund. Now, this is where goods or services are provided to other agencies of the government or to other governments themselves here. So that would include like central motor pools here, central printing or central purchasing department, and also like a computer center here that's going to service the entire government here. Okay, so that would be your typical for your internal service fund. Just remember, internal service fund provides goods or services to other agencies of the government, whereas your enterprise fund, that's providing goods or services to the general public. So that's really the basic difference between these two funds. Okay, here, and again, these enterprise funds have what they call restricted assets, and we're going to be looking at those here. And those restricted assets, they're going to be tied into the current liabilities here, where the current liabilities can be paid only with the restricted assets. And those restricted assets could be cash or some investments, upon which some limitations have been imposed. So there are going to be limitations imposed on any assets you have that are restricted for a specific purpose, and you can't pay any cash or investments unless it comes out of those restricted assets. Again, restricted assets and related liabilities are recorded in specially designated accounts to ensure you segregate your dollars here so they don't get mixed up with other funds or other accounts here. We're going to be looking at the restricted assets here. Okay. Now let's go up here and let's just look at a basic example here. And we're just going to be looking at the enterprise fund here for the municipality's water utility. And we're going to be looking at some billing collections here and some construction expansion project. And we're just going to be looking at some basic concepts here so you understand what's going on here with, in this case, the enterprise fund. Okay, and with this enterprise fund, this is where we're going to have our include restricted assets and the related liability. So that's sort of a new concept here. It's used in the enterprise fund, and the enterprise fund here is part of your governmental accounting. But the enterprise fund is going to operate much like a normal business using accrual accounting. So let's look at our first concept here, where we're going to be building, we're going to expand in this water utility. We're going to have to drill some new wells or expand our water utility capacity here. So this is going to really be a construction project that's going to be taken on here. And what I'm going to be showing here, and everything is in T account forms, and when you're dealing with these governmental accounting, or in this case the enterprise fund here, you have to note what's going on in your titles for each one of these accounts here. So that's the key here when you're dealing with this enterprise fund and governmental accounting in general. So let's just say, for example, here we're going to take on this construction project here. And the construction project's actually going to be estimated, contract, they're estimated to be $930,000. But we're going to have to come up with some funding for this construction project. So what we're going to do here, let's just say we have some, this is where we're going to look at the first concept here on this, under restricted dollars received from the general fund. Again, for this construction project to expand our well. So from the general fund, we're going to receive $300,000 here for the project that's going into our enterprise fund. And this is where we're going to have set up restricted dollars is going to be received here from the general fund. So in our enterprise fund, we're going to have, this is the key here, you got to call it restricted assets, cash for this particular construction project. In this case, we'd have well expansion or the expansion of our water utilities for the particular project here. So key is restricted assets here, and what we would have to label as such, and then this is really the cash account here, and it's set up here as a restricted asset. So let's just say we received $300,000 here from the general fund. So we debit our restricted assets account here for $300,000. And then moving over to our credit, that's going to go as an interfund transfer here from the general fund. Again, this is tied in to the restricted assets. We're only going to be using this interfund transfer here from the general fund only can be used as a restricted asset here for the expansion of that water utility, drilling on that water utility. So transfer, interfund transfer from the general fund, credit that here for $300,000. So this is where we first use the restricted dollars received from another fund, and we transferred in monies here from the general fund to for this expansion project here, and it came into our enterprise fund. Okay, so let's look at the case here, water usage billings here. Let's just look at typically how we'd use normal accrual accounting here for any billings. So now for the water used here for this water utility, we've broken it down here between the public usage here, that's going to go to our accounts receivable, and then city usage within the city itself. The different departments have going to also use water here. So what we want to be looking at here is our normal accrual accounting, and this is what we would use here. It's not going to be modified accrual here. So let's look at our situation here. Say, for example, we have billed, the public has been billed, debited in our accounts receivables billing underwater here. They have been billed $220,000, and you debit or increase your accounts receivable here by $270,000 for the amount billed here for the monthly billings here. And then the city usage, that would go from due from other funds here, billings for water used here. You would title it as such. You would debit that here for $67,000. Okay, so you've breaking it apart here between the public usage and the city usage. Now, what we're going to our operating revenue, again, we title that operating revenue here, billings for this service here, this water service. That's going to include both the total amount here of our accounts receivable from our public usage here, and also the due from other funds here for the city usage. Total amount here is going to be credited for $287. So we accrued the total dollars billed. And the point we want to make here is that if you were using just regular governmental accounting, you'd have to set up an allowance account here as a reduction to your accounts receivable. And that would be, the allowance account here would be reduce your accounts receivable, but you would not recognize the total operating revenue. It would be reduced by the amount of the allowance that you have. In governmental accounting, you would allow for funds that wouldn't be collected, people that wouldn't be paid here for their water. They wouldn't be paying for their water usage. So what you would set up again is an allowance account that reduces your accounts receivable here, and then you wouldn't, that by your operating revenue would be reduced by that amount here. I'm not showing it here, but that's the concept that you'd use here. But for normal accrual accounting, we recognize the total amount of your accounts receivable from the end. Your total billed amount here is going to be recognized here in your operating revenue, and then later on when you don't get paid, then you would recognize it as an expense. So that's the basic difference here. Governmental accounting, and we're not using it here, would have set up a allowance account to reduce your accounts receivable here, and you wouldn't have recognized your total, your operating revenue. The total dollars wouldn't be recognized here based on that allowance. But when we're dealing with accrual account or normal accrual accounting, we recognize the total billed amount here. And then when the actual collections are made here, let's just say accounts receivable received $190,000 here from the public, reduce your accounts receivable by that amount here, and due from other sources, we'd credit or reduce that amount here, $42,000. So you can see here both of those amounts, just say we received those dollars here, and then you'd recognize them as cash, your debit or your cash account for the billings for the water usage. But everything has to be titled here. Make sure you get in your enterprise fund here, you would have, remember this, everything would be titled here, your billings for water used here, on identifying where your monies are coming, where your billed amounts are going into and where your monies are coming out of. Okay, so just remember here, with the enterprise fund, it's operated like a normal business. Use normal accrual accounting and not modified accrual that would be used for governmental accounting, and then you would therefore, you wouldn't set up any allowance account. You'd be normal accrual. You'd be expensing any uncollectibles. Okay, so that's about how you take care of what you're providing here. This enterprise fund is set up to provide water to both the public and city uses, and that's basically how you'd make your collections. Now let's go down here and let's expand on our construction project here. Now, what we're going to do here, we're going to need, besides that $300,000 that's coming in from the general fund for this project, we're going to issue some revenue bonds here. And just looking at a very basic entry here, what we would do here, we're going to, our title of this is going to be, again, restricted assets here. And what in the revenue bonds here, that's going to be for our bonds payable. We're going to set that up here, and then we're going to have tied into that, we're going to have restricted assets, the cash received for this revenue bond. So this is going to be our cash account here. So what we're going to do here, let's say we make the bond issue here. Revenue bonds for bonds payable, we're going to credit that here for $700,000. Say we issued $700,000 worth of bonds. So then under that credit goes to the revenue bonds here, bonds payable essentially, $700,000. And then for our restricted assets here, again for the cash revenues received for the bonds, we're going to debit that here for $700,000 for the amount that we received here. These are restricted, what you'd have to call it restricted assets. These this revenue received here, this cash revenue received in the bonds is going to be restricted such that it can only be spent on that particular construction project for that well drilling project. So this is where you're going to, our other concept, remember this is where you're going to have a restriction here on the bond issue. So the cash is going to be restricted to usage only on that particular construction project. Okay, so there's where we issued the bonds here. Now let's go down and let's look at, again, the revenue bonds here. These are restricted. and those are they're restricted. Money received from the revenue bonds is restricted here in your cash account for that construction project. Now let's go down here and look at again. This is the case where we're going to issue some contracts here. Let's just say we're going to issue a contract. Estimated cost of the contract here is $930,000. And 2 points that we're going to be looking at here. So when we issue this contract here, normally governmental accounting is going to set up their budgetary accounts for the fund inflows here and also appropriations and so forth. But when we're talking about the enterprise fund, it does not use these budgetary accounts. You have a budget, but you don't use the governmental budgetary accounts that you would normally use in government accounting. So let's just say we had $930,000 here. So there's where you'd have a budget, but the $930,000 wouldn't have to be set up as an appropriation. Okay. Now let's just say we come along here and we have some payables. For that construction project for the year, we got billed $360,000. So for our contracts payable, again, under restricted assets. This is an restricted assets account here. You'd have to label it as such. You'd credit it here for $360,000. And then the billed amount, this is where you're going to look at your asset account here for the construction in progress here. The estimated cost is $930,000, but we got billed for $360,000 here for the year. So debit your construction in process account here for $360,000. Okay, so that's the amount that we're billed for the year here. So we're starting to set up our asset account here for the construction in progress here. But the contracts payable, let's look at that. Now let's say here at the end of the year here we paid $300,000 on that contracts payable. We billed $360,000, but we paid only $300,000. So we would, on our contracts payable, we debit that here for $300,000. Now remember, this contract's payable, that's going to be a restriction on, it's a restriction on our reliability or our payable. We can only pay it out of, let's go up and look at it. We can only pay it out of the restricted assets here for the cash revenue from those bonds here. It also could have come from the cash for that, coming in from the general fund here, but I'm just for the cash transferred in from the general fund. But nonetheless, it comes out of restricted assets. The contracts payable, it's tied into restricted assets. You can't pay anything out of the contracts payable, only from restricted assets here. So let's go to our restricted assets account. In this case, we credit it or reduce it by the amount paid here, that $300,000 for the year here. So that's the key point here. When you're using this enterprise fund, you set up those restricted accounts here, and any payables coming out of, like this contract that we had set up here, you cannot pay anything out of the payable. Well, you can pay it out, but it has to come from your restricted assets for the cash revenue, in this case, from those bonds here. So we would credit or reduce our restricted assets here by $300,000, and also our contracts payable here by $300,000. So remember, this related liability is really a restriction here. The related liability is restricted by the funds that are sitting here in your restricted asset account. So if you didn't have any funds in your restricted asset account, then you couldn't pay those contracts payable. So what we want to take out of here, just looking at it, remember, enterprise funds, we do not use the budgetary accounts here. It's set up as a normal commercial business, sort of a self-sustaining business here. So we're not using any governmental budgetary accounts. Yes, it would have a budget and so forth, but it would be typical to whatever a commercial business would have, or private enterprise. Okay, so what we want to take again away from here, we'll take a look at it here. The revenue bonds that are issued, they're tied into the revenue bonds issued for this expansion project for this enterprise fund here. They're tied into the restricted assets. Any monies received from those revenue bonds here get moved over into the restricted assets for the cash for those revenue bonds for that particular project that we're looking at here. And then any contracts, any payables that are on that particular project, they can only be paid out of that restricted asset for our cash account. Okay, so that's what we want to take away from our example here for proprietary funds. They're run similar to a business type activities. You use normal accrual accounting. The funds, I didn't go into it, but they would carry their own fixed assets and long-term debt. Long-term debt was shown here. And also the fixed assets. We didn't depreciate anything in this case here. But accounting, and then the accounting procedures resemble that really of a commercial business. The idea is that these enterprise funds here and also the internal service fund, they have to be self-supporting like a commercial business. Okay, so that'll summarize our topic.